Hello everyone, welcome to the chapter on making capital investment decisions. So in this introductory video, I'm just going to give you a quick overview of what this chapter is really about. Look, walking into this chapter, you know, or I expect you to know, the basic discounted cash flow valuation framework. What I mean by that is this. If I give you a project, so let's suppose that there's a project and on that you know what the timeline looks like. So let's suppose here's time period 0, 1, 2, 3, and 4. And suppose I tell you that, look, this project requires an upfront investment of $10,000, but then it's going to yield cash flows of $3,000, $4,000, $6,000, and then maybe $9,000. If I give you these cash flows, and on top of that, if I tell you that, look, your discount rate, call it, denoted by the symbol K, let's suppose that that's 15%, then equipped with this information, you can tell me what the NPV of the project looks like. You can tell me what the IRR of the project looks like. You can tell me what the profitability index looks like. You can tell me the payback. You can tell me the discounted payback. My point is that you can calculate all these different investment evaluation metrics and then tell me whether this is a worthwhile investment or not. Now, what is this chapter about? This chapter is basically about us stepping back one step and trying to understand, where these cash flows are coming from. Up until now, you were told what the project's cash flows were like, and you were told what the discount rate was. So it was easy. You just had to do all this calculation. But now we're going to take one step back and ask ourselves, how do we determine the cash flows from a project? And so these cash flows are known as financial cash flows. Sometimes they're also called free cash flows. So maybe I'll write the term free here as well. I'll explain what free means over here. Sometimes they're also called project's unlevered cash flows. So unlevered cash flows, financial cash flows, free cash flows, they all mean the same thing. I'm going to use the abbreviation FCF mostly to denote these cash flows. And so the main thing that we are going to be doing is then this. We are going to be determining what is the financial cash flow of the project in year 0, what is it in year 1, what is it in year 2, 3, and then finally 4, or more specifically, if it's a project which lasts for T years, what are the financial cash flows till time period T? The main point is that we want to determine the cash flows at these different points in time. Why? Because once we have these and we have the discount rate, then we can use these different ways to evaluate our investment. There are two things about financial cash flows that I'd like you to bear in mind even at this early stage. Number one is this. Whenever we say, what are the financial cash flows of the project? Oftentimes students feel like financial cash flows are always positive, as if we're going to be getting cash flows or the investors are going to be getting cash flows, and that is certainly definitely not true. Financial cash flows can be positive and they can be negative. In fact, at time period 0, typically the financial cash flows are negative. What that really means is that at that stage, the project or the asset that you are investing in, it's just eating up money. It's not making anything for its investors. And so please bear in mind that cash flows, or the financial cash flows or free cash flows that we're going to be calculating, they can be positive or negative, as they have been in the past as well. So please don't feel like cash flows can only be positive. They can be both positive and negative. So that's one thing. The second thing that I would like you to do is bear in mind that the framework that we will use to calculate financial cash flows, and that comes later, we'll see what are the ingredients that go into calculating these. Please understand that this applies to projects, but this also applies to firms, because if you think about it, firms are nothing but a collection of multiple projects. And so my point is that the framework that you're going to use to determine the cash flows for a project, that is also going to be useful for you to determine the cash flows of firms like Netflix or Google or Amazon. I mean, it's going to be more complex, but the underlying framework is going to be the same. And that is useful. Why? Because later on, when we're going to be talking about something like mergers and acquisitions or valuing a firm, one of the ways in which we can do that, or we will do that, is by calculating the financial cash flows that we are expecting from the firm, today, and then at time period 1, and then at time period 2 and 3, and then so on and so forth. And then we'll be discounting those cash flows. So understand what's happening over here in terms of projects and how we are determining cash flows for projects, because later on this same framework is going to help you with valuing firms as well. So that is the underlying, the core sort of motivation behind this chapter. We're going to see some other interesting stuff along the lines as well, but this is the heart of this chapter, and this is what we're going to talk about now. How do we determine the financial cash flows for projects? What is the underlying framework? We're going to do this using some examples, and then we're going to also study the same question using different applications. So stay tuned.